On June 19th, TCS fell over 6%. Not because it reported bad results, not because some a big client cancelled a contract, not because anything changed inside the business. But it was because Accenture, an American IT giant with a completely different revenue mix, heavily weighted towards US federal spending, cut its guidance on the other side of the world. And the market is treating every IT company as an identical, sold TCS as if it were Accenture. I bought TCS in that days that followed, in the range of 2050 to 2150. And I want to show you exactly why. Not as a reaction to a price dip, but as a deliberate entry to into what I believe is one of the most significant mispricing in large cap Indian company right now. The stock that was once the largest company in India's market cap in India by market cap, a business with over $30 billion in annual revenue, 600,000 employees mm, across 58 countries, um, $40 billion in total contract value last year, is trading at roughly half its all-time high. The market expectation, the market's explanation for the gap is straightforward. AI will destroy the traditional IT service model. These 600,000 employees are a liability, not an asset. And the company is too large and too slow to adapt. My thesis is different. The market has made a category error. It looked at a company being disrupted by AI and concluded that the disruption would be fatal. I believe that the disruption is real, and TCS is adapting to it faster than the market is crediting. Disruption and destruction are not the same thing. Dis- and that distinction between a business being disrupted and a business being destroyed is worth 2,400 rupees per share, if I'm right. One more thing before I get into the analysis. This video was recorded before um, TCS's Q1 FY27 results. So I will leave three scenarios, and according to the scenario, my thesis's next step would change. So let's start with what this business actually is. Let me start with the what TCS actually is. TCS is because the market's current narrative about this company is built on a version of TCS that stopped being accurate several years ago. Most people think of TCS as a body shopping operation, a company that sends Indian engineers to write code to Western corporations at a fraction of cost of local talent. That model, a large headcount, low margin, commoditized services, is the model the AI disruption narrative is attacking. The problem with that the problem with this description hasn't been updated in at least a decade. TCS generates over $30 billion in annual revenue across eight different industry verticals. Eight different industry verticals. Um, BSFI 31.9%. Um, consumer insurance, consumer businesses at 15.4%. At life sciences at 10.5%, manufacturing at 8.8%. No single vertical represents more than one third revenue of the company's revenue. That diversification is not an accident. It is deliberate. It is deliberate portfolio construction that means no single industry disruption can break the business. North America 48.5%, UK at 16.9%, Continental Europe at 15.6%, and Asia Pacific at 8.3%. Lastly, India at 6.1%. These are these are these are not data points. These are the geographic spread of TCS's revenue. Meaning no single regulatory change, no single economic downturn, no single geopolitical event can simultaneously damage every revenue stream. This is the number I want to pay close attention to. Um, this one, yeah, because this dismantles the body shopping narrative more efficiently than anything else. 66 clients contributing over 100 million each to, increased by four clients from the last quarter. 139 clients over 50 million and over 311 clients over 20 million. These are not transactional relationships. A client paying TCS $100 million a year has TCS embedded in its core operations. Their banking infrastructure, their supply chain systems, their HR platforms, their cybersecurity architecture. Replacing TCS is a multi-year, multi-hundred million dollar project that most enterprises will not undertake unless TCS fundamentally fails them. That client stickiness, built over 56 years of consistent delivery, is the most durable competitive asset TCS has, and it is the asset market is currently ignoring entirely, while it focuses on the AI disruption narrative. TCS banks in banking infrastructure running the core operations of the financial institution across the world. Thesis in Igneo: AI-powered automation deployed across 80% of SaaS customers, productivity 150, boosting productivity 150%. TCS Mastercraft processed over 16 million lines of legacy code for modernization in FY25 alone. TCS Ion assessed over 64 million candidates through its learning and assessment platform. These are not consulting engagements that end when project does. These are platforms embedded in client workflows that generate recurring recurring high retention revenue regardless of headcount. A bank running TCS Banks does not switch to a AI agent it built. Um, it builds its AI, but it builds its AI on top of banks. Here's the framing I want you to carry into everything else that follows. The market is pricing TCS as if it was a commoditized body shopping operation that AI can replace. The businesses that actually exist is a deeply embedded platform platform-led multi-vertical enterprise technology partner with 62 clients paying over 64, 66, I think, 66 clients paying over $100 million a year, and 56 years of institutional trust behind every contract. Those are not the same business, and the gap between what market thinks TCS is and what it actually is the gap where the opportunity lives. Ugh. Now I want to be precise about why the stock has fallen, and I want to do something I think most bull case videos on TCS don't do. I want to give the bear case its full force before I argue against it. Because here's the honest truth. Some of the concerns our teachers are real. Not all of them are sentiments, but all of them are temporary. And if I don't address the genuine ones directly, everything else I say in this video is less credible. I want to. So let me walk through all four layers and I'll tell you which ones I think are sentimental and which ones deserve genuine respect. All three layers, well, three, not four. Layer one, AI will destroy the traditional IT service model. This is a dominant narrative. The sphere is specific. AI agents and coding assistants are automating the repetitive, low-key software tasks that historically drive a significant portion of TCS's billable hours. Clients who previously needed TCS and 50 TCS engineers to maintain a legacy system now only needs 20 engineers and a suite of AI tools. The headcount to revenue relationship, the mathematical foundation of TCS's business model for 56 years, is breaking down. I want to be direct about this. This concern is real. It is not sentimental. The linear headcount model is genuinely under pressure, and TCS's own management has acknowledged it. The chairman himself said the company will soon deploy as many AI agents as human employees. Where the market goes wrong is in the conclusion. It looks at a disrupted revenue model and concludes the business is being destroyed. The correct conclusion is that the revenue model is being transformed from headcount based outcome to outcome produced. And that transformation, while painful and expensive in the short term, positions TCS in better it positions TCS better in the long term than a smaller competitor cannot afford to make the same transition. The market pricing the transition cost as if a permanent impairment. I believe it is temporary. I believe it is a temporary margin headwind on the way to structurally superior business model. I want to be honest. This is a bet on execution. If TCS to complete fails to completely transition, uh, the bear case wins. Layer two, the layoffs looked like a company in crisis. Between 2024 and 2026, TCS reduced its workforce from approximately 613K to 582K. Mask layoffs, union pushbacks in Pune and Mumbai, forced resignations, reports of coercion at facilities from outside. This looks like a company losing its control of its operations. Here is where I give the bear case partial credit and pushback. The partial credit: workforce disruption at this scale carries real operational risk. Morale damage during restructuring creates attrition among the employees. TCS most wants to keep the skilled, experienced ones who have options. If TCS loses its best AI talent to competitors or GCCs. During the restructuring, the transition gets harder, not easier. That risk is real and ongoing. The pushback. The financial evidence directly contradicts the crisis narrative. Operating margins hit a 4-year high of 25.3% in Q4 FY26. During the same period as the layoffs, net profits rose 12.22% year on year in Q4. In Q4, a company with genuine operational crisis does not a company in general operation crisis does not deliver um, 4-year high margins simultaneously. The restructuring is working. This it is just working uncomfortably. Layer three, clients are building in-house centers. This is the concern I think deserves the most analytical respect, and the one most bull cases on TCS dismissed too quickly. Corporate clients, particularly in United States or North America, are established are establishing global capability centers in India. These are internal IT operations that do work previously outsourced to TCS or Infosys and their peers. The concern is not just that TCS loses some revenue today. It is that the structural shift towards in-house capability permanently reduces TCS's addressable market for the Indian outsourcing, for ID outsourcing. Um, I'm not going to tell you this thread is imaginary. It is a real and it is structural. The question is magnitude and TCS's response. GCCs are most effective for standardized, repeatable work. Complex multi-geography, multi-system enterprise transformations still require the scale enterprise and relationships that only TCS scale vendor can provide. The $100 million clients I described in the previous section are not building GCCs to replace TCS. They're building GCCs for specific functions while depending on their relationships on their TCS relationships for the complex work. On response, TCS has created a dedicated GCC unit that helps clients build and manage their own centers, converting what looks like a competitive threat into a new revenue stream. Whether that pivot succeeds is an open execution question, but this strategic response is the right one. Um, okay. Three layers. Let me be honest how I categorize each one. Layer one, AI disruption, real, not sentimental. The market's conclusion is wrong, but concern is legitimate. Layer two, workforce restructuring. Real operational risk, but financial evidence contradicts the crisis narrative. Layer three, GCC threat, the most structurally concerning of all of the three. Partially but not fully addressed by TCS's response. None of these three concerns represent a permanent impairment on TCS's competitive position, but two of them, AI disruption and GCC threat, are structural shifts that require successful execution to navigate. This is not a situation like Indigo Paints where the business kept compounding while the price fell. This is a situation where the business genuinely slowed while management executed a transformation. The bet is whether the transformation succeeds. That is that is a higher uncertainty thesis than anything else in this portfolio series. I want to be transparent about that. The bear case on TCS rests on one assumption that TCS cannot make a transition from the left box to the right. That a 600,000 person organization, um, that a 600,000 person organization built on selling hours to will be unable to build itself around selling outcomes, and this is the time it takes to attempt that, and that in the time it takes to attempt that rebuild AI narrative competitors and in-house client capabilities will have taken enough market share to permanently impair the business. That is the coherent bear case. I want to give it that credit. But I want to show you the evidence that it's already being disproved. The traditional TCS model, what the bear case is attacking, was fundamentally a labor arbitrage play. Skilled skilled Indian engineers delivering the same quality work as Western engineers at a fraction of cost. As AI reduces the cost of software development universally, the arbitrage narrows. The competitive advantage of cheaper labor becomes less valuable when AI can do the same work for even cheaper. That threat is real. I said so in the collapse section, and I'm not walking it back here. But here's what the market is missing about TCS and where it actually is in this transition right now. AI revenue annualized at $2.3 billion in Q4 FY26. That is not a pilot program. That is not a press release. That is a commercial. That is commercial revenue being generated at scale from AI service that clients are paying for. With 6.3% quarter-on-quarter growth, growing faster than any other segment in the business, five 5,000 AI engagement executed with customer satisfaction of 94.8% to um, to 217K associates with AI skilled, 270K trained in AI and machine learning during FY26 alone. 1,833 patents filed for AI-led inventions. The market is pricing TCS as if the AI transition hasn't started. The evidence says it started years ago and now generating $2.3 billion in annualized revenue. Let me show you three specific things TCS is doing that bear case thesis does not adequately account for. First, Hypervault. TCS launched Hypervault, a dedicated center business, AI data center business partnered with major alternative asset management firms, including TPG. The commitment of 100 megawatts of capacity with the opportunity to expand to 1 gigawatt. I think about what it represents strategically. TCS is not just delivering AI services built on other people's infrastructure. It is building and owning the infrastructure itself. And the partnership with OpenAI includes committed capacity at Hypervolt, meaning OpenAI's models run on TCS owned data centers that TCS charges OpenAI to use. The company that was feared to be a casualty of AI revolution is now becoming the infrastructure of further evolution. That is not a defensive pivot, that is an offensive repositioning. Second, OpenAI and Anthropic partnerships. From the con call, and I want to use the actual language here because it matters. The partnerships with OpenAI and Anthropic are structured as what TCS calls 360-degree partnerships. No traditional go-to-market arrangements, but four pillars of relationships, covering infrastructure capacity, enterprise product deployment, industry-specific AI, solution co-development, and strategic go to market motions. The significance: TCS is not a reseller for OpenAI products. It is a co-developer of industry-specific AI solutions built on OpenAI and Anthropic models. That distinction converts TCS from a distribution channel into a value-added partner with proprietary intellectual property with the AI stack. The IP is defensible in a way that labor arbitrage was never. Third, Incognito Code Accelerator. Incognito Code Accelerator is an AI-powered tool that automates code generation. Has and it has been deployed across 80% of SA, 80% of SaaS customers and boosting productivity by 150%. I want to be precise about what that means for the headcount to revenue model in question. Incognito is not replacing TCS engineers with AI. It is making TCS engineers 150% more productive, which means TCS can deliver the same work with fewer people at higher margins, or deliver more work with the same people at higher revenue. Either outcome improves the unit economics of the business. The bear case assumes AI replaces TCS. The evidence shows TCS deploying AI to improve its own delivery efficiency before competitors can use AI against it. That is exactly the right strategic response to a disruption threat. Now, and this is the most important point in this entire section, all three of those developments, Hypervolt, the OpenAI Anthropic partnerships, and in Ignio, are built on a foundation that AI cannot replicate in the time frame the bear case assumes. 66 clients paying over $100 million each, 25 20 plus years of embedded platform relationships across banking, insurance, healthcare, and manufacturing. The Tata brand and governance reputation that opens doors in boardrooms that AI native startups cannot access. Domain enterprise accumulates across 56 years of enterprise transformation. An AI startup can write code faster TCS than a TCS engineer. It cannot replace the relationship that exists when a global bank CFO calls TCS's account manager at 2 a.m. because their core business system has a problem. It cannot replace the trust that exists when an insurance company hands TCS the key of to their entire policy administration infrastructure. It cannot replace the regulatory compliance track record track record that tier 1 financial institutions require before entrusting their core systems to any vendor. That foundation, the bottom box, is what the transition is built on, and it is what the market is not pricing correctly. Reliance transformed itself to from a petrochemical uh, and retail conglomerate into a dominant Indian telecom operator. In approximately 5 years, the market did not believe that it would work when it was announced. The disruption Jio caused to in- incumbent telecom operators was existential, not temporary, not manageable, existential. TCS is not attempting to disrupt its industry the way Jio disrupted telecom. It is attempting to lead its industry, lead its industry's technology transition dis- rather than be disrupted by it. That is a less dramatic but more defensible transformation because TCS is not asking clients to switch to something new. It is asking existing clients to evolve their relationship into the AI era. The difference between those two types of transformation is the difference between high risk disruption and low risk evolution. TCS is attempting evolution using the relationships and platforms it already has um, as the foundation for the AI service it is building on top of them. Is the transition guaranteed? No. I said so in the previous section, and I'm consistent on this. The execution risk is real, but the evidence as of Q4 FY26 is 23 $2.3 billion in analyzed AI revenue, 94.8% customer satisfaction, record TCV of $40.7 billion, 4-year high operating margins, suggesting a company that is executing a transition completely, not perfectly, competently, yeah, and consistently. And competent, a competent, consistent execution by world-class franchisee adapting to a AI tech to a technology. A shift is exactly what creates a re-rating opportunity described in the previous section. The market's thesis is that TCS cannot make this transition. Every quarter, the evidence says it already is making it. Before I get into the financial picture, I want to do something I haven't done in any other video in this series. TCS's Q1 FY27 board meeting is on 9th July. This video is being recorded before that result arrives. By the time you're watching this, you already know what happened. But instead of waiting to tell you what the result showed, I want to give you the analytical framework before the result arrives. Three scenarios, what each one looks like in the numbers, what each one means for the thesis, and what I watch in each case. Because the purpose of this exercise is not to predict the result, it is to show you how I think about results before they arrive, so I can so that they so that when they do arrive, I'm not interpreting them in uh, to so I'm not interpreting them to fit a pre-existing narrative. I'm checking them against predefined expectations. Scenario 1, strong results. What it looks like. Um, dollar dollar revenue returning positive growth year on year, even marginally. Operating margins hold 24 operating margins holding above 24%. TCV sustaining above $10 billion for the quarter. AI revenue continuing its 16% quarter on quarter growth trajectory. What it means for the thesis. The cyclical interpretation of FY26's revenue decline is confirmed. The market's narrative that TCS in a structural decline becomes harder to maintain against a quarter of positive dollar revenue growth. This does not complete the thesis. Quarter uh, One quarter of recovery is not a trend, but it is a sign. It is the first sign, or it is the first concrete evidence that the sentiment is being shifted, and that the bear case is central assumption. Permanent revenue impairment is wrong. Expect the sentiment to begin shifting. What I watch next. Whether Q2 FY27 shows acceleration rather than just a recovery. A strong Q1 followed by a strong Q2 would establish a trend. A strong Q1 followed by a flat Q2 would suggest the recovery is choppy rather than durable. Mixed revenue, mixed results. What I what it looks like: rupee revenue growing, but dollar revenue still flat or marginally negative. Margins holding or slightly compressed. TCV solid but below 10 billion for the quarter. AI revenue growing but below 16 Q to QOQ growth, Q to Q pace. What it means for the thesis. Mm, the thesis is intact, but the timeline extends. The thesis is intact, but timeline extends. A mixed result means the cyclical recovery is taking longer than the optimistic scenario assumes, which is common in IT sector cycles, where client spending decision improve lag economic improvement by 2 to 3 quarters. The thesis does not break on a mixed result. The patience requirement increases. What I'm what I've watched next. The management guidance on H2 FY27 recovery trajectory in a mixed quarter. The most important output is not the numbers themselves, but what management says about the next 2 quarters. Specific guidance, margin trends, revenue growth expectations, TCV conversion timeline, signals whether management sees improvement coming, or they are or whether they're managing expectations downward. Um, Scenario 3, weak result. What it looks like. Dollar revenue declining again year on year for a fourth consecutive quarter. Margin compression despite the restructuring narrative. TCV deteriorating below 9 billion. Management guidance cut or withdrawn. Um, what it means for the thesis. This is where I need to be honest rather than defensive. Weak Q1 FY27 specifically, the combination of continued dollar revenue decline plus TCV deterioration would move this position from standard monitoring to active reassessment, not immediate exit, active reassessment. Here's a precise distinction between dollar revenue declining alone in Q1 FY27 is concerning, but not thesis breaking. The restructuring and spending freeze could still be masked as masking underlying demand. Dollar revenue declining against TCV deterioration would suggest the pipeline is not refilling, which is a structural scenario, not a cyclical one. That combination would trigger a formal re-examination of whether question one of my checklist, is the cost fixable or permanent, has changed its answer. Um, What I watch next. Whether TCV deterioration is broad-based across geographies and verticals or concentrated in one specific area. Broad deterioration is structural. Concentrated deterioration is in a specific geography. North America federal spending, for example, is sector specific and more manageable. Three scenarios, three different implications, all three mapped against specific matrix. Before the results arrive. When you watch this video, knowing the results, you can check my framework against what actually happened, not whether I predicted correctly, whether the framework I used to think, but whether the framework I used to think about the result was the right one. That that is the only test that matters.
Let me show you what the financials actually say, because this is where the bull case either holds up under scrutiny or it doesn't. And I want to be direct about something before I walk you through the numbers. TCS's financial picture is more complicated than Yes Bank and Indigo Paints. In those two cases, the narrative was clear: operational improvement visible across multiple metrics simultaneously. TCS is more mixed. Some numbers are exceptional, others are genuinely concerning. I'll tell you which o- I'll tell you which one it is. Revenue. Mm, the numbers in the number uh, bears point to. In FY 2026, the full revenue in rupee terms in millions was um 2.6 millions. So that's like 27, 26 crores, 26,000 crores. And um down, no, it's up 4.6% from it's up 2.6 it's up 4.6% from the previous year. um in in constant currency, the decline, but in constant currency it was a decline. I'm not going to minimize this number. The rate of the rare annual revenue decline at TCS is genuinely significant. The company grew through multiple economic cycles without a dollar revenue decline. That this occurred in FY 26 is the clearest financial evidence that the bear case concerns are not purely sentimental. The context: discretionary IT spending froze across North America and Europe as clients managed economic uncertainty, economic uncertainty and tariff concerns. Currency headwinds amplified the dollar decline beyond the rupee decline, beyond what constant currency figures show. These are real external factors, but external factors do not make the numbers less real. Now, the revenue growth is only showing 4.6% because of the dollar increased. Let me show you this. USD INR. So from April 1st, April 1st, 2025 to around April March 31st, 2025. Let me just show you that again. So here we go. We click this and we go to April 1st, and then we go upstairs, up to March. And then we go to March 31st. That was March 30th, March 31st right here. So 9.4%. And as you know that TCS is half of its revenue, around half of its revenue comes from US. So nine. Um, so if US dollar increases and rupee weakens, then this also increases. That means so then TCS's revenue also increases because TCS is taking its revenue in US dollars and then it's converting into rupees. So that's why the company got a currency benefit. But if you take the currency benefit out of it, then its revenue is in negative. Next we go to operating margins. FY26 full year operating margins are at 25%, the highest in 4 years. Q4 FY26, um, Q4 FY26. Let's just look at it. Q4 to FY26 was 27.8%, which is also really good, which is also the highest actually. Mm, this is the most important financial data point in the entire analysis, um, and the most counterintuitive one too. Revenue declining while margins expanding, means one thing precisely. The cost reconstructing is working faster than the revenue headwinds is hurting. The business is becoming more efficient at, at exactly the moment the market is treating it as a declining franchisee. The genuine a genuinely deteriorating business does not deliver 4-year higher margins. It defends margins quarter on quarter. It defends margins for a quarter or two and then watches them compress as volume decline overwhelms cost reduction. TCS's margins are expanding, which means that revenue decline is a cyclical demand weakness, not a structural pricing erosion. Now let's move on to net income. Net income is mixed but directionally positive. At Q4, let's go back to quarter four. Q4 FY26 net income was around 137 millions 137 no wait 137,000 millions, yeah, or also known as 13,000 crores. mm, yeah, 13,700 crores. It is up around mm, it is up to 28%, 28.8%. Let me just recheck it here because I'll have to recheck it, of course. Here it's up to 12%, so let's just take the 12% as it is, okay? So yeah, up 12.22%. Yeah, that's 12.22, yeah. Up 12.22% year on year. The quarterly direction is right, but I want to flag Q3 FY26 specifically here. This one. Net profit fell. Net profit Q3 FY26 didn't fall. Yep, net profit fell. This to this. Here it's not showing that net profit fell because it is not counting the exceptional cost. But yeah, net profit fell 13.92% year on year. in that quarter. That numbers appears in my research note and deserves honest acknowledgement. A single quarter of significant profit decline during reconstruction period is consistent with transformation thesis, restructuring cost, AI, investment, workforce retraining all hit the P&L simultaneously. But the kind of number that makes um, a confident bull case harder to make without acknowledging it. It well, long story short, it's mostly because of this exceptional cost. We can actually search because, like, I think I had this on my research note, but I can't find it. So let's just search because Google is your best friend here. Why did TCS Q3 FY26 um result? Why was why was bad? Go and then we'll just search what were the exceptional charges. Exceptional charges. Okay, so it was some new labor law impacts, legal provisioning from a US lawsuit, and workforce reconstruction cost. So it was these three. Okay, but the main point is the Q4 recovery of 12.22% growth suggests that the Q3 compression was transactional rather than directional. Two consecutive quarters of profit growth in Q1 FY27 would confirm that interpretation. One quarter does not. I think, yeah, and I think this was showing a profit growth of 28% a quarter on quarter, not year on year growth. TCV. I don't think it's TCV. I don't think there is a TCV section here. Nope. Yep. I don't think there's a TCV section here. Total liability. No. Yeah. Anyways, so at TCV, 40 billion, $40.7 billion for FY26, among the highest in TCS's history. This is the number that separates the cyclical interpretation from a structural one, and I want to explain precisely why. TCB is contra TCB is contracted future revenue. It represents deals signed, commitment made, works that will be billed in future quarter. A record TCV in a year of revenue decline means pipeline is refilling faster than current year revenue is disappointing. Clients are not abandoning TCS, they're signing longer and larger contracts with it while simultaneously freezing discretionary spending in the short term. That divergence record forward commitments alongside current year revenue weakness strongest is a signal. Strongest evidence that the revenue decline is cyclical, not structural. A business losing relevance to its clients does not simultaneously sign $40 billion in contracts with with those same clients. Free cash flow. Free cash flow is the basic foundation of TCS, I think. Here.
and then we'll just go here, and then we'll just make it in billions so we can read it much easier. So it's much easier to read. Yeah, strong free cash flow generation throughout the 5 year period. Um, 12,908 crores in cash balance here, as you can see. 12,908 crores in cash balance on balance sheet against 11,283 crores of total debt. Interest coverage at interest coverage at 57.8%, 857.8x. Debt to equity at 0.11, 11%. This balance sheet funds the 6.5 billion AI investment commitment over 5 years entirely from internal resources. TCS does not need to raise capital to execute this transformation. It does not need to. It does not need to take on meaningful debt. It does not need to make dilutive equity insurances. The transformation is being funded by the business itself, which means the management has fully the strategic flexibility to execute on timeline that makes operational sense rather than timeline that capital market would impose. Let's summarize this. Let's summarize this. What this analysis tells me. Two exceptional numbers, one operating margin at 4 year highs, and TCV at a near record, both pointing in the direction the thesis requires. One mixed number, net profit Q3 weak because of exceptional income. Q4 recovered. Direction currently positive but requires confirmation. Um, One foundational number, free cash flow and balance sheet, gives management the runway to execute without external concern. This is not the clean uniformly. This is not the clean uniformly financial positive financial picture of the business. Full recovery mode. Full recovery mode, it is the financial picture of a business in the middle of a genuine transition with the leading indicator pointing at the right directions and the lacking indicators still reflecting the transition cost. This is exactly what you expect to see in a high quality franchisee navigating a technology shift, not a crisis, not a triumph, a transition in progress, on track, not yet complete. Okay, so let's head on to valuation session. Let me bring the financial analysis into valuation. I want to be precise about which valuation method methodology is most relevant for thesis, especially because this is a different type of business from the other positions in the series in the math. So the math methodology matters. So I'm using my so so yeah multiple. First, let's go through multiples. Where the mispricing lives. Current PE is approximately 14. Um, Current PE is approximately 14. Uh, tra- Trailing earnings depending on the period used, 14 to 16 depending on the period we use. Historical PE is 24. Industry PE is 20 here, 21. Even after the sector-wide correction, historical EV to EBITDA is right now, EV to EBITDA is 9.77. Historical is 17.2, and industry is 12.
Price to sales is 2.8, historical 5.3, industry median 2.96. Every multiple is below historical, below industry, and in some cases, what the current market is assigning to peers with weaker fundamentals. A business generating $30 billion in revenue, maintaining 25% operating margins, with 40 billion dollars of TCV, a record pipeline of AI engagements, trading below industry multiples because the market has concluded the transition will fail. That is the mispricing, not complicated, not subtle. A world-class franchisee, exceptional current financial trading at distressed multiples because of forward narrative. The execution evidence is already disproving. Now let's head on to my. I want to explain the methodology briefly before the numbers, because calling it proprietary without. So we're using, first of all, we're using the fundamental reversion valuation. This is my own model, and I want to explain it briefly before the numbers. Because calling it proprietary before without explaining what it does would be intellectually dishonest. Um, the FRV model asks one question: if the fundamentals of the business have compounded at a specific rate over a long period of time, what price should the stock be reflected that should the stock be reflected at that compounding? Adjust the current growth expectations and qualitative factors. Um, it is not a DCF. It is not assume a specific terminal value. It means it is a mean reversion model anchored on the observation that over a long period of time, price follows fundamental compounding. When price has deviated significantly below fundamental compounding rate, it tends to revert. FRV model ranges anywhere from, let's go back here, anywhere from 3760 to 4388. And implied upside will be anywhere from 80 to 109%. I want to be honest about the limitations of this model before I use the numbers. Any reversion model assumes the fundamental compounding rate continues forward at approximately the historical rate for TCS, whose growth rate has slowed from double digits to single digits. That assumption requires qualification. The model is most accurate if TCS successfully completes the AI transition and returns mid to high single digit revenue growth. If growth stagnates at 2 to 3% permanently, the fair value implied by the model overstates the opportunity. And this is why the scenario analysis number I heavily weighed is around 3878, because it incorporates the assumption of a more moderate growth rate rather than full return to historical growth rates. Now, I would like to tell you this. Um, we can't predict what would go on in the future. We can't predict the growth rate, we can't predict nothing. It's really hard to predict it, okay? Especially macroeconomics. But what we can see is we can value our whole company based on the past and according to where it should be standing. That's what we did here. So even if the growth rate isn't the historical growth rate, we can still the company will still be undervalued, and the company will probably most likely will be valued at this range, because the because the company
well, because the company's historical valuation was at this range, and also even if we value that it at like from there, our present value would be at this range. So that's what I'm saying. We can't. So like, I'm not trying to predict future growth. I'm just trying to look at the company if it's present, if it's right now, if it right now if it's undervalued, overvalued, or fairly valued. And from there, I will go on every year and like see if it was fair valued, overvalued, or undervalued. That's what I'm gonna do. I'm not gonna predict the future growth rate of the company because that's honestly really hard to do and really inaccurate, and it's really hard to do consistently. Even if you get it right one or two times, it's really hard to do consistently. Now, let's go to the other thing. The lifetime high, for 4580 is the target at entry range of the is a target for me. Again, this is not financial advice. This is the target for me. Um, this is the target at the entry range of 2050 to 2150. Reaching that target over 3 years implies a CAGR for approximately 28 to 32%. That return requires both earnings delivery and multiple re-ratings simultaneously. Both are required, neither alone is sufficient. The asymmetry, and this is the number that justifies the positions sizing at 5 to 6% of the total portfolio, with the downside estimated at approximately 1500 right here in the COVID levels. The level where the balance sheet strength and dividend yield would provide a floor. The upside to target is approximately 2,400 to 2,500 per share. The downside from the entry is approximately 550 to 650 per share. That's a roughly 1 to 4 asymmetry. For every dollar of downside risk at the entry price range, there's approximately $4 of upside target. To break it, to break even this position sizing decision, I need to win only 20% of the time. I believe this thesis has a significantly higher rate than 20%, which is why it's at 5 to 6% rather than 2 to 3%. But I want to put one honest caveat on the valuation before I move on to the close. The target price of 4584 assumes the full rating back at all-time high. That all-time high has achieved a period of peak sector optimism, peak liquidity, peak growth expectations for Indian IT. Even if TCS executes a AI transition perfectly, a return to those exact conditions is not guaranteed. A more conservative scenario would be anywhere from 3754 um, to 4 to anywhere from 400, the 4000s level. This implies approximately a 80 to 100% gain, which is honestly really good for a big company like TCS. Um, Again, I would like to clarify that I do own TCS. Um, I'm targeting the lifetime high because I believe the AI infrastructure and build out, Hypervolt and OpenAI partnership, the enterprise AI transition creates a growth profile that could exceed what the available what was available in 2021. But I hold that target with appropriate humility about what the market was pricing in 2021 versus what the market should be pricing in 2026. Let me bring everything together. TCS is the fourth position in this portfolio series, the fourth archetype. Not a governance collapse, not an industry downturn, a quality compounder in a technology transition, temporarily mispriced because the market confused disruption with destruction. The business, $30 billion in revenue, 66 clients paying over $100 million each, 40.7 billion dollars in TCV, 25% operating margins at a 4-year high, is significantly stronger than its current price implies. The transition $2.3 billion in annualized AI revenue, Hypervault, OpenAI, Anthropic partnerships, 217,000 associates trained in AI is further advanced than the bear case acknowledges. The uncertainty, dollar revenue declining in FY26, GCC structural threat, um, execution risk on a 600,000 person transformation is real, and I have not minimized it. The thesis in two sentences. If I would have to write the thesis in two sentences, it would be: thesis a world-class enterprise technology franchisee being disrupted by AI adapting to that disruption faster than the market is creating. A gap between what the market believes about TCS's future and the execution evidence shows that about TCS's present is approximately 2,400 rupees per share at current prices. I own TCS in the ranges of 2,050 to 1,500 because the asymmetry for $4 for upside for every $1 of downside justifies the high conviction position in a business that has everything required to win a technology transition except the market believes it will. Five things I am watching every quarter from here. Dollar revenue returning to a positive growth. Every single most important metric for the single most important metric for cyclical versus structural debate. AI revenue crossing $5 billion annualized. The proof of that transition is generating a scale, not just pilots. TCV sustaining above $10 billion per quarter, the leading indicator that the pipeline remains healthy despite near-term revenue pressures. Operating margins maintaining above 24% before through the AI investment cycle. The evidence that the transformation is not being funded by margin sacrifice. Any evidence of competitive displacement in $100 million plus client tier, the most direct signal that the client relationship moat is eroding. These five metrics will be tracked every month from my side. If any of these, if any of the thesis break conditions I've defined are triggered, I will cover it. I will cover in the monthly updates that follow it, with the same analytical depth as this video. In the month it happens. Just the process the capital will follow.